Stock market is now down 21%.
Because we're now down 43%.
We're down by between 3 and 4.5%. What in the world is happening on Wall Street?
We're in the last days of this country surviving.
Have you ever felt like the economy is trying to tell you something, but you don't quite speak the language? You know, it's constantly sending out these signals through prices and charts and all this data. And look, we're not here to play fortune teller. Instead, think of this as a bit of a detective story. Together, we're going to investigate some of the most important economic clues out there and just learn how to decode what they might be telling us about the road ahead. So let's get started.
So here's our game plan. We're going to start with a classic clue, the price of gold. From there, we'll dig into government bonds to tackle a big question of trust. Then we're going to decode what some people call history's most reliable signal before checking the temperature of the stock market. And finally, we'll look at a really rare signal of extreme stress. And just remember, the whole point of this is to simply understand the signs, not to predict the future.
All right, let's dive right in. For our first piece of evidence, we're turning to one of the oldest, most watched signals in the entire financial world, the price of gold. I mean, for centuries, this is what people have looked at as a kind of barometer for economic uncertainty. So, the big question that really kicks things off is this. What is behind the recent super sharp acceleration in the price of gold? Gold doesn't typically make moves like this without a really good reason. So what are investors seeing that's causing this kind of shift? This chart, well, it tells a really crucial story. Gold's price isn't just a number, it's a reaction. When investors start getting fearful about financial instability or maybe a recession, they don't go chasing assets that promise explosive growth. Nope, they seek safety. So what you're seeing here is money moving into a defensive position. It's a huge signal that the underlying mood in the market is all about protection, not expansion. Okay, so from the tangible safety of gold, our investigation is now going to lead us to a cornerstone of the entire global financial system, government bonds. And with this clue, we start to explore a much deeper and more fundamental question, and that's a question of trust. And just take a look at this. From Turkey to Japan, Germany to Canada, we are seeing the exact same trend. The yields on 10-year government bonds are climbing. This isn't just happening in one country. It's a really widespread phenomenon. And that tells us we're looking at a global signal, not just some isolated local issue.
So what in the world is a bond yield? Well, in simple terms, it's the return a government pays you to borrow your money. Now, government bonds are often called risk-free assets. They're supposed to be the safest investment you can possibly make. So that raises a pretty important question. Why would governments need to offer a higher return on something that's supposed to be risk-free? The answer is the signal itself. Rising yields mean investors are demanding more compensation for what they see as rising risk. It's a subtle but really powerful indicator of declining confidence.
Now let's move on to our third piece of evidence, and this one builds directly on what we just talked about with bond yields. We're about to look at an indicator that has one of the most formidable and frankly unnerving track records for accuracy in modern economic history. We are going to decode the yield curve. Okay, so normally the logic here is pretty simple, right? If you lend out your money for a longer period of time, say 10 years, you're taking on more risk than if you only lend it for 2 years. A lot can happen in a decade, so you'd naturally expect a higher return for that longer-term loan. This is what a normal, healthy yield curve looks like.
But sometimes that logic gets completely flipped on its head. An inverted yield curve is when investors demand a higher return for a short-term 2-year loan than they do for a 10-year loan. It means the market is more worried about the immediate future than the distant one. And here's the kicker. This strange signal has a perfect track record. It has shown up before every single US recession in the last half-century.
You can see the pattern right here on this chart with incredible clarity. The red area shows the difference, the spread between the 10-year and 2-year bond yields. Every single time that red area dips below the zero line, it means the yield curve has inverted. Now look at those shaded columns, which mark past recessions. The pattern is it's undeniable. The inversion happens first, and then a recession follows. It has played out this way time and time again. But here is the most critical detail, the nuance that so many people miss. The recession doesn't usually start when the curve is way down in negative territory. The real danger zone, historically, is the transition period after the inversion, when the curve starts moving back up towards positive. That phase can last anywhere from 6 to 24 months before a recession actually begins. And that transition, that's exactly where we are in the cycle right now.
Okay, so let's recap for a second. We've seen signals of fear, declining trust, and a historical recession warning that's flashing. So now let's turn our investigation to the stock market itself and ask a simple question. Are prices actually reflecting economic reality, or has the market gotten a little overheated?
And to help us answer that, let's bring in a voice of authority. I mean, when Warren Buffett talks about valuation, people tend to listen, and he has a favorite indicator for taking the temperature of the entire market.
And here it is, the Buffett Indicator. It's a really simple ratio. It just compares the total value of the stock market to the country's entire economic output, or GDP. As this chart shows, the indicator is currently sitting at 230%, which is dramatically higher than its historical trend line. By this one measure, the market is signaling some pretty extreme overvaluation.
And it's not the only valuation metric that's flashing a warning sign. There's another one, which compares the stock market's value to the amount of money in the system, and it's telling a very similar story. It has now reached an extreme level that we literally have not seen in over 2 decades, since the peak of the dot-com bubble back in 2000. It suggests that asset prices might have detached a little from the underlying fundamentals.
All right, we've looked at fear, trust, history, and valuation. For our final piece of evidence, we're going to examine an indicator that measures the tension, the actual conflict between policymakers and the financial markets. And this is a signal of some pretty extreme stress.
Now, I know this indicator sounds really complicated, but just stick with me. It's actually pretty simple when you break it down. On one side, you've got the Federal Reserve setting its official interest rate policy. On the other side, you have the bond market, which is constantly making its own bets on where rates are headed. This indicator just measures the disagreement between the two. So when it spikes, it's a huge signal. The market is basically shouting at the Fed saying, hey, we don't believe your current policy is sustainable.
And this is what's so remarkable. This level of disagreement is incredibly rare. I mean, looking at this chart, you can see that the indicator has only hit these extreme peaks a handful of times in recent history. And each time it did, it was signaling that something, somewhere, had to give.
Let's just lay out that history clearly, because it's really something. The first peak was in 1989, right before the 1990 recession. The second peak was in 2008, right before the global financial crisis. And the third peak? Well, that's the period we're in right now. Each time this signal has flashed this brightly, a major economic event has followed.
So we've gathered our clues. We've looked at gold, bonds, the yield curve, market valuations, and policy stress. Now it's time to step back and put all the pieces of our investigation together. What does it all really mean? You know, when we pin all these clues up on the board, a single, really consistent story starts to emerge. It starts with fear, right? We see that in the rising price of gold, with investors running for safety. That's reinforced by a decline in trust, which is being signaled by those rising government bond yields. Then you have history's most reliable indicator, the yield curve, pointing towards a future slowdown. Meanwhile, stock valuations seem to be detached from reality, sitting at historic extremes. And finally, a rare stress indicator shows the market in direct conflict with policy, a signal we've only seen before major economic resets. Each clue on its own is a warning. But together, well, they paint a very clear picture.
And I really want to be crystal clear about the takeaway here. The purpose of this was not to give you a date on a calendar or to cause any alarm. The goal is to empower you. It's about learning to read the language of the market and to understand the messages that these powerful, historically significant indicators are sending us.
So I'll leave you with this final thought. We've looked at the evidence together. We've decoded the signals. If you think of all these indicators as forming the language, the question isn't what I think or what anyone else predicts. The real question is, what do you think the economy is trying to tell us right now?